Welcome to this Critical Explainer. For the next few minutes, I want you to think of me as your dedicated wealth manager. We are going to pull back the curtain on the banking system, exposing the mechanics that silently operate behind the scenes. But more importantly, we're going to talk about how you can strategically protect and grow your capital. If you're tired of leaving money on the table, you are absolutely in the right place. So let's dive right in. Former US President Andrew Jackson once warned that if people truly understood the rank injustice of our banking system, there'd be a revolution by morning. This quote highlights early banking concepts that actually explain the deep historical roots of the public's distrust today. It shows how modern monetary policy often operates at your expense. But look, instead of a revolution, what professionals like us need today is a highly informed strategic response. We just need to understand the rules so we can play the game to our advantage. Here is our roadmap for today's briefing. We'll start with historical roots and traps, move into fractional reserve mechanics, then evaluation of financial products. After that, we'll cover strategic debt and inflation shifts, and finally, capturing returns via bank stocks. All right, Section 1, Historical Roots and Traps, the Low-Yield Savings Dilemma. Consider this stark mathematical reality. You deposit $1,000 into a standard savings account, taking comfort in the idea that it's safe. The bank pays you a minuscule 0.5% annual yield. But on the flip side, that very same bank takes your $1,000 and lends it out, often through credit cards, charging those borrowers up to 20% interest. This massive discrepancy reveals a fundamental trap, doesn't it? Banks are profiting enormously by collecting way more in interest than they will ever pay out to depositors like you. So while your money sits there gathering a trickle, the bank is effectively using your funds to generate massive returns for itself. And the reality of that low yield becomes a genuine financial hazard when we factor in a typical 3% inflation rate. Inflation silently saps your purchasing power. Think about it. If you're earning a mere 0.5% on your savings, but inflation is running at 3%, you are taking a net loss every single year. The real value of your money is just eroding away. I literally cannot warn you strongly enough here. Leaving large sums dormant in a low-yield account is practically guaranteeing a loss of wealth over time. Moving on to Section 2, Fractional Reserve Mechanics, Money as Debt. To really understand the system, we have to define its engine, fractional reserve banking. This is a system where banks hold only a fraction of your deposits in reserve and then lend out the rest, effectively creating brand new digital money out of thin air. It sounds almost like a conspiracy theory, right? But it's actually the foundational mechanism of modern finance. Grasping this is absolutely critical for your personal wealth accumulation strategies, because it shows that our entire banking structure runs on one very fragile element, and that's confidence. If confidence vanishes, the whole system wobbles. Let's walk through exactly how this builds. You deposit your $1,000, thinking it's locked securely in a vault somewhere. Instead, the bank takes 90% of it and lends $900 to someone else who needs a loan. Suddenly, the bank's ledgers show your $1,000 plus the borrower's $900. That single deposit effectively becomes two different balances. New digital money is conjured into existence the exact instant that loan is made. So, the macro implication here is pretty staggering. Almost every new dollar in the economy is actually born as a loan that must be repaid with interest. Because the system requires continuous borrowing just to keep functioning, there is always more total debt than physical currency in existence. For you, as a focused professional, the takeaway here dictates a massive shift in strategy for long-term growth. Cash is inherently inferior to productive real assets. Things with real intrinsic value, like property, precious metals, or owning equity in a business, are insulated from this endless debt cycle in a way that paper currency simply isn't. That brings us to Section 3, Evaluating Financial Products, Protecting Your Capital. You have got to remember this cardinal rule when dealing with these institutions. Banks are not unbiased financial planners. Their primary job is to generate profit for themselves, not to ensure that you make money. While a friendly bank manager might suggest a great-sounding mutual fund or a special savings plan, you really must view them as salespeople. Those nice, glossy brochures and polite conversations often mask hidden fees or ongoing commissions. You are the customer to be sold to, not a partner in a mutually beneficial setup. To truly protect your capital, you need to adopt a strict vetting process. Think of this as your insider's checklist.
Step 1. Read the fine print carefully. Step 2. Ask very direct questions about hidden fees and real returns. And Step 3. Always compare the bank's offer against independent investment alternatives. Banks rely heavily on convenience and, frankly, a bit of ignorance to secure their profit margins. By executing these specific steps, you protect your hard-earned investments from being drained by unnecessary fees, and you lock in the best possible strategic advantage.
Let's pivot to Section 4, Strategic Debt and Inflation Shifts, Building the Portfolio. We're basically operating in a two-tiered lending system. Take a billionaire like Mark Zuckerberg, for example. When he walks into a bank to finance a house, the bank sees a near-zero risk of default. Because of that, they offer him incredibly low interest rates, sometimes literally lower than inflation itself. The super rich use that ultra-cheap borrowed money to invest in higher-yielding ventures, practically printing a profit from money that cost them next to nothing. Meanwhile, the average customer faces much higher rates because of perceived default risk. Banks absolutely love keeping average people trapped in high-interest debt because every single dollar above the principal is pure profit for them. So to counter this and build a truly resilient portfolio, you must execute 3 practical shifts. Number 1, move dormant cash into growth assets like index funds or real estate to explicitly outpace those inflationary losses. Keep only what you absolutely need for daily use and invest the rest. Number 2, aggressively pay down expensive consumer debt. Carrying balances on 20% credit cards is just a guaranteed wealth destroyer. And number 3, improve your credit profile to unlock the top-tier loan terms the wealthy enjoy. This allows you to use strategic debt as a wealth-building tool rather than being crushed by it. Finally, Section 5, Capturing Returns via Bank Stocks, the ultimate pivot. At the end of the day, you have a stark choice. As a passive depositor, your returns are negligible, and you actively lose money to inflation. But as a shareholder, you capture dividend returns and capital gains. You are actually profiting from the fees and interest the system charges everybody else. It's a complete flip of the script. By acquiring open market shares in large established institutions like JP Morgan or Goldman Sachs, you tap directly into their massive revenue streams. You transition from being the person paying transaction fees to capturing regular dividend returns as a partial owner. And here is the kicker. When banks benefit from inflation because the money they lent out becomes relatively cheaper to repay, you, as a shareholder, actually share in that upside. Now, of course, you should always do your own research or consult an independent advisor to choose stocks that fit your specific risk profile, but simply knowing that you can gain the system in your favor by owning the banks, that opens up an entirely new financial dimension. So, I'll leave you with this final question. Are you positioned as a passive depositor or an active owner of your financial future? Knowledge is absolutely your greatest tool for navigating this system. Now that you understand the trap of low yields, the reality of how money is created through fractional reserve banking, and how inflation quietly saps your savings, you can't unsee it. Stop letting the banks dictate your financial fate through their clever tactics. Reassess your portfolio today, seek out productive real assets, outpace inflation, and position yourself to truly thrive. Thank you so much for joining me on this explainer. Now get out there and take action.